One. And welcome everybody to another Smart Money Circle update. I'm very excited about today's show. With us today is Stephen Lee, who's principal at Logan Capital Management with approximately $3.8 billion in assets under management. Stephen, welcome to the show.
Thank you for taking the time. Happy to meet with you, talk with you and your audience.
So Stephen, I always like to begin. Can you just tell us a little about your story, how you got to where you are today, please?
Sure. Yeah, Logan's very much a team-oriented firm. My partners and I started it back in '93. So we've been through some interesting markets together, both some of the great bull and bear markets, which has been nice. We started running fixed income portfolios and growth equities back in the '90s when that was a really wonderful thing to do. And then over the years have added investment teams that have complementary strategies. So we've really focused on, building strategies that we can use to help our clients meet their goals. And we do a lot of work with taxable entities, insurance companies, and work with financial planners all over the country through leading firms.
I love it. So tell us about your background, if you don't mind, from the personal side. How'd you go to school? How'd you get involved? How'd you get into the firm, and why money management?
Always had an interest in the business. Candidly, my father was in it, so I grew up listening to a lot about investments and things like that. The cassette tapes he would put in the cars. We drove to the lake house where investments. So it's always been ingrained in that. And one of the interesting things about our group here at Logan is Philadelphia. We're based out of Philadelphia, and Philadelphia back in the time was kind of considered a value town. And my three partners and I, we're growth guys. We use charts, we look at history, and we were able to find each other because there weren't that many of us. So that was really the genesis of how we got together. We thought about the world and investing in a very similar way. Had some nice intros in terms of insurance companies as lead clients, and really built it from there. So, had a little bit of an accounting degree and a little bit of, economic history. So,
I'm a growth guy also, so we can have a lot to talk about and
right.
all this fun stuff. Okay, so tell me a little about your investment strategy, if you don't mind, high level, and how you look at markets and stocks and all that fun stuff.
Yeah, exactly. Yeah, so focus a little bit on the growth strategy, and really what we do, my team and I, we really do take the time to step back and look at the economy, kind of where we are in history. The saying is history doesn't repeat, but it rhymes. And that's certainly something that we've found to be true. So we think stepping back and really looking at what's working in the economy, what are some of the challenges, and then thinking, what types of businesses, what were the characteristics of businesses that did well in that environment? Just having that general perspective. So we start with that. It doesn't mean that we necessarily think that the economy is going to do, we're going to grow at 3.2 or 3.8% of GDP, but what's the general trend and what types of businesses do? So, and really that's the goal of really trying to build portfolios for people that are about preparing rather than predicting. It's hard to predict, but you can prepare. So given those predispositions, we use quantitative analysis. We have a screen we've used for years and years and years. And the premise on that is we look for companies that the analysts, we use a lot of Wall Street research. We look at the analyst, what are they doing with the earnings estimates? Are they taking them up and down? What companies are holding up better? And, as you mentioned, you're a growth guy. Well, growth guys, you're always like, well, in a bull market or a growing economy, it seems easy. But where we've actually found value with that tool, in addition, is in challenging times, like we might be here, a little bit possibility of a recession. But what companies are holding up better? What management teams are having their earnings drop a little bit less? And often those companies become the leaders on the next cycle out. And then the third thing we do is technical analysis. As a growth investor, we make money by finding companies that appreciate and do well in the long term. So charting is just, are we starting to see other investors see the potential? And when companies show up on all three, that's a buy. So
I love it. So, okay, I'm going to ask you a lot more follow-up questions in a few minutes. But you've got the bells are ringing, so to speak.
Right.
Let's talk about risk first. So
sure.
How do you handle risk, and what are some mistakes do you see people make with respect to risk management?
Well, I think a little bit of the risk, with risk, there are a couple things. And one of the things we did in the late 90s is we're growth guys. And so what would pair well with us? So we actually bought a deep value, high dividend yield strategy. Nice. So we think a lot of managing risk is having a sense of where you're going, what's the goal? I have a client who's institutional. He says, we're investing for generations. Well, that changes your perspective.
Correct.
If you're saving for retirement or saving for long term, what the market does in the next 6 months is interesting, but maybe not relevant to the goal. So know where you're going, and then build a plan and prepare for some of the challenges along the way. Probably the most common mistake we see investors do is reacting to today's headlines and zigging in and zigging out. That's tough. It's tough to do. So really stepping back, having a plan, preparing for the markets are volatile. The world's not the world doesn't go up in a straight line. So kind of preparing for that and understanding that is really, really important.
I love that. So when you use technical analysis, most people use technical analysis for entries and exits, and they use risk based on entry, and then you exit if it falls X% below your entry point. But when you have an infinite game, like the markets are, investing for generations, it never ends, right? So how do you, solve for X when you want to use charts to enter and exit, but you also want to have a long-term time frame?
Yeah, and I guess where we use charts is often for context. So we were just talking, our team, we were meeting this morning, and there were 2 or 3 companies, and that, the chart on the one company looked a little challenging, but then we looked at 3 or 4 peers, said, okay, so everyone in that industry had the same move. That's a very different answer than if only one of those companies. So we looked at 4 companies and they all had the same move. Okay, so it's not company specific. So then the discussion becomes, well, was there a headline today that impacted the industry that maybe we shouldn't weigh as heavily? So we find technicals to be excellent sources of context. And again, on the upside, if you have one company breaking out, and others are sort of lackluster, maybe that's a positive development. Then you look, why are they breaking out? What's going on with that company? So we really use it as context. And it's interesting. We engaged a company right after 2008, real challenging market, housing crisis. And we went through and said, down 10%, would that have helped us? So we had them, their behavioral finance company, and went through all the companies we look at. And this is again on the growth side, companies we owned, companies we could have owned. They said, well, if you did 10% out in a market that downs 20, you sold everything. And you actually impaired your value more than riding out those companies that were holding up better on a relative basis. So we look at it as context. If I said that in a way that makes sense, but
no, that makes perfect sense. So if the market's down 50%, your stocks are down 5 or down 10, that's outperforming on a relative basis. So I guess you're a big relative strength guy. Is that correct?
Yeah, relative performance is important.
Okay.
With a little bit, relative performance to peers, where sometimes relative strength can be a little broader.
Got it.
So it's really context. We think technicals are a great way to get context.
Got it. And then for fundamentals, what are you looking at? You said you have some qualitative screens. Are you looking for explosive earnings growth? Or if you could speak to that a little bit, please.
Yeah, a little bit. We want companies that are innovative, creative, and profitable. So, and then we're talking about that hype curve a couple of weeks ago internally. And sometimes there are ideas that are just fabulous ideas, but they are so far away from being businesses that you don't want to invest there.
Right.
We wait to when that idea has been distilled a little and it's actually starting to show profits, starting to become a business. And we think good long-term money can be made in that stage. So some of the screening we do is we want profitability over a couple of years, and we look at valuation. We look at valuation as a PEG ratio, which is the PE to growth. So price to earnings. And then we look at it relative to growth. So if you have a company growing at 10, and its earnings growth rate is 10%, then that's a PEG of 1. What's nice about using PEG is it doesn't screen out, I'll use your phrase, explosive growers. They're going to be expensive, but are they expensive relative? Have they earned that expense? Expensive, but worth it, I like to think about. So those disciplines kind of keep us out of trouble. We don't have ideas that aren't businesses. And then we okay, is there a rational basis for that? And so what we found is, and I'm going way back when, but the late 90s, just because that's when we run, you had the .com boom, and hopefully your audience will remember this. Otherwise,
I was there.
Okay, very good, perfect. Okay,
yeah.
You were valuing eyeballs, not businesses. So there were, there were a lot of business that just didn't make sense. So we lagged a little on the upside, right? But then when the world sorted things out, as always happens, those companies that were actually businesses did well and were foundational growers for the next 10 to 20 years. So that's what we like to do. Let's make sure this management team can actually turn these ideas into profitability.
Got it. So cooler heads prevail over the long term. You want to make
Right.
sure you're not paying up for eyeballs or some other metric that can't be monetized. You want to make sure it impacts the bottom line.
Right.
And okay, that makes perfect sense.
Yeah.
Okay, so any other investment related, before we move on, any other investment related nuggets of wisdom you'd like to share with the audience with respect to picking stocks or managing portfolio risk or anything along those lines?
Well, yeah, and we talked a little bit about our growth side. And then the other thing is having different components within your portfolio that tend to complement each other. So and knowing when they tend to perform and how they fit. So for example, high dividend yield stocks. We have a team we brought in 1999. Dividends were really out of style back in the late 90s.
Right.
And growth stocks did well. We had made a lot of wealth for our clients. And we thought, how do we protect this? And kind of in a know thyself moment, our team said, every time we try to buy a stock cheap, doesn't work as well. But we found a team that buys cheap stocks really well.
Okay.
So then, we introduced to clients, hey, maybe this is something you'd want to do to complement what we do. And that worked out well. And if you look at that pattern of returns over the last 20 years, it's worked really well, but not necessarily in a predictable manner. And a good example of that happened in 2020 when we shut down. And you would have, knee-jerk reaction would be, okay, let's buy all these big high dividend defensive stocks in 2020.
Yeah.
Well, what worked? The growth stocks did.
The growth stocks, right.
So if you had a portfolio that had strategies that did both, you were okay. If you woke up and said, okay, these are going to be a real challenging environment, let's get defensive, that was hard to do, because I would have never called that Amazon and Microsoft were going to be your leaders in 2020, but they were.
Right.
Because behavior changed faster than people would see it. So it's, again, preparing, but trying not to predict. So we think that's really critical.
I love that. So let's, if you don't mind here, well, two things. Number one, I'd like to tell the audience about your ETF. You have a Broad Innovative Growth ETF,
Right.
LCLG, for anyone who's interested. Can you talk about that ETF? Are the same principles that you described, or are there other variables?
It is. It's exactly, that's running our growth strategy. So the ETF is really an efficient way to get that growth strategy.
Okay.
So it's the same process we've been doing since the late 90s. So we've been running this through wonderful times and challenging times for growth, but it really follows this philosophy. So there's three tenets in terms of taking the time, understand the economy, who might be doing well. Let's look at earnings leadership for companies that are actually making money, and then having getting confirmation on that in terms of technical analysis. So that's really the strategy. So we ran it as a 40 Act fund for several years. Decided the ETF has, we believe in the advantages of ETFs for investors. There are a ton out there, which I'm sure you share with your audience. But so we're relatively early in an active ETF. It's a conversion. So we've been running the strategy. So it's a new product with 20 years of history behind it.
Got it. And that works for individual investors and also for financial advisors or institutions. Anyone can buy it.
Yep.
Okay.
Yeah.
Beautiful. And now, next question. A lot of the audience here, they're achievers, they're the alpha type personality, and they want to be able to roll up their sleeves, so to speak, and dive in and replicate somewhat of what you're doing here or use nuggets of wisdom for their own trading and their own performance to enhance it. So this is the fun part of the conversation. I'd like to shift the conversation to some timeless lessons you've learned along the way.
Sure.
Can you share some with the audience, whether it be professionally, personally, anything under the sun?
Well, the way you described your audience, find companies that are them. Companies that wake up in the morning, how are we going to grow today? Do we have pricing power? Is what we're doing unique? Competing on price and having a price advantage and being the cheapest works up until a point. Particularly now, we're concerned about inflation, which we think actually we're getting to more historically normal interest rates than we had over the last 10 to 20 years. Free money is not normal. So with that context, how do you find companies that could do that? Well, if, what's the old stock that we've owned forever, Apple, what makes that company interesting? Well, they charge a premium. No one will ever say that any of their things are the cheapest choice. So they have almost a cult-like following.
Right.
And people value and will pay. So if they have to add a little bit to their price, they can do it. They have a recurring revenue component. So business, people consider their devices almost a necessity. So if times do get a little challenging, that's probably, the iPhone, the Mac, If you could see here, though, I did probably drink the Kool-Aid a little, but there's a lot of Apple around here. But the same token, I think that's a nice characteristic. Look for companies that people really value and are willing to pay a premium for. You can see it. We'd often talk about consumer stocks because those are things, Lululemon has that, they have that brand, they're charging a premium. So we think those are companies that if you're worried about the current conditions, well, what's going to be able to play through? And if things cost more, will they be able to pass those along? So we've always looked at pricing power as an absolute critical component.
Yeah.
And the other thing is we look at financial stability. Do you have the balance sheet? Do you have, these companies have their financing locked in? Or there's some businesses in the last couple of years that their eyes, well, we're getting a sense of this could be a good idea. We'll try it. We'll probably sell our products a little bit of loss, but we can always go borrow more money. We can always get more money. That works in really effervescent environments, but it's not necessarily a long-term investment.
Got it.
That being said, well, here, you have a question, so.
No, complete, by all means, please.
That being said, in some of these mature companies, you can get these opportunities. I'm thinking back to Amazon. Years and years ago when they were building warehouses and things like that, people got skeptical. They're spending all this money on next day delivery. And our team looked at that and thought, that's why we're in that company. They're investing in their edge. And if they can pull that off, which they did, they're going to really have an advantage. So yeah, their earnings took a break for about 6 months to a year while they made those investments. But then what we do when we see that earnings dip, you can tell we are chartists as I'm doing this, but then we look at the revenue line. Is the revenue line still growing?
Right.
So if you have a company that's continuing to grow on the sales side,
right,
and the earnings are dipping because of investment, that's okay. Historically, we've added to companies like that.
I love that. So when do you enter and exit position? Like, do you look for breakouts from 52-week highs, from bases, cup with handles? Do you look for other elements, or what makes you enter and what makes you exit?
It's more the combination. So one of the nice things is when we're screening on earnings leadership. So what we found over the years is analysts tend to change their expectations. So we think a company is going to be 11 cents versus 10, or they're going to earn 9 cents versus 10. So they change those numbers before they get around to changing the buy, sell, or hold. So the reason we screen for that, we do it on a weekly basis, is because we find we get to that insight a little ahead of the headline. Oh, let's take the stock from a hold to a buy. So what we often see is really that combination. If we see a company come up on that list and it's new to the thing, we want to get into why is that movement happening? And then we dig into ask the question, why are the earnings better? Well, if the earnings are better because they're cutting costs, for a growth investor, that's not necessarily what we look for. But if they're starting to sell more, then we do like to see that. Then once we have that, then we look at the chart. And okay, is there starting to be a little bit? So a lot of the technical patterns you talked about, we look at, but they don't necessarily drive the ship in and of themselves, because we want those other components. Because we want to be there for multi-years. Our ideal situation is to find a company we can own for a fair number of years. So a lot of those technical patterns, they're great indicators, but they're not necessarily long-term.
Yeah, understood. That's a really good way of explaining that. I love that. How about for exits? Do you exit based on a change in the thesis, like the thesis is busted, or do you wait for this chart to break a 50-day moving average, or what?
So we use the charts as I always like to say, the check engine light in your car, which we won't be able to use once we all have electric cars. But right now we can still use that. Correct. But you don't have to pull over, but hey, there could be something here. So we use a chart as that. So then we use that as a catalyst to go check the thesis and to get to say, is this company still the company we invested in? Are they still doing what we want to do? Is there something going on? So we use technicals to check the work. We don't always sell on technicals because, as we discussed earlier, there are times in the market where every chart looks bad. Yeah. So you want to own. You don't sell everything in that pot. So we'll use that as a catalyst. So then most common reason we'll sell a stock is if they're losing their pricing edge. And I'll give an example from years ago, right? Since we seem to be in that mode, but Starbucks. We were long-term holders. And then there was a period there where they sort of got away from coffee before Schultz came back. And Starbucks, they were kind of competing with McDonald's on breakfast. And we're thinking, you're not going to win a price war with McDonald's. And so we looked at channel checks and we saw that every Starbucks had 25 cents off a cup of coffee. They didn't do it all the same way, but if you went to different regions, it was the same number, interestingly enough. Like, okay, you're starting to discount. We're not in love with that. Let's find another idea. So we exited that position. We ultimately did come back to it a little later, as they got back to their focus. But, you go in the time they were opening up a music store in Miami, they just had lost.
Correct.
Not that I don't say they lost their way, but they deviated from the reason we own the stock. So that'll be it. And then, of course, risk management is once a position gets to be too high a percentage of the portfolio. For us within the fund, we use 6%. We trim a little because we're, went back and looked at the work, and new ideas could outperform that very mature idea. So we may keep it, but let's find the next new idea.
Got it. It's funny that you mentioned Starbucks, because I literally pulled up a chart of Starbucks when you were speaking earlier. And you said you're looking for that hyper growth phase. So I wanted to see how many stores they had. They have 35,000 stores, and I was saying you wanted to buy Starbucks when they have 5,000, not when they have 35,000, because you want that growth.
Exactly.
And then a few minutes later, you said Starbucks. That's funny.
Right.
Okay.
Yeah. There we go.
That's the crux of it. Okay, wonderful. So let's talk about mistakes. Stephen, you've been in the money management business for a long time. You grew up in the environment.
Right.
You've interacted with lots of investors, both individually and professionally. What are some mistakes you see people make, and how do you avoid them?
Sometimes just being too short term. It was the last 2 years, the headline feed that we've gotten, challenging. We'll put it that way. Challenging. So so step back and look at that headline. Does this really change the long-term trends that we're invested in? It's very easy to wake up in the morning and say, oh, we got to get out. Let's go to cash, or let's go to this sector. So we think a lot of it drives that in and out, kind of trying to be like a rabbit, just we're a little bit more of let's be slow and steady. That being said, there are times when companies are mature. Confusing a well-recognized name with quality. Familiarity isn't always quality, it's just familiarity. And we saw that, with some of the well-known banks in the last couple of weeks here. Just because we've heard of it doesn't mean there couldn't be problems there. So, there's that delicate balance of I've heard of it, it's large, it's got to be stable. Not always the case. Right. Think of all the great well-known names that kind of didn't. Sears, we'll pick on Sears.
Right.
So, knowing what you own and really knowing why you own it is that we think is really critical. And when that gets out of sync, that's often where, we have investors have made mistakes and seen others make mistakes,
Got it.
So we constantly question, is this still the company that we bought?
Yeah, I love that. In other words, it's almost like, you've seen the movie Back to the Future.
Mm-hmm.
Remember the chalkboard in the alternate 1985 when Doc was talking to Marty and explaining there's an alternate 1985 and there's a line here and then this is that line. So if your line is your thesis, you want to make sure the stock stays on that line. If something happens where it's going to go off the line, you want to get out and find something else that can stay on the line. I love that. Yeah. All right. Well, what is the best advice you give your 30-year-old self or 20-year-old self or younger people listening?
Have a plan. Really sit down and think about what you're trying to achieve. It's so much easier to get there if you know where you're going. It sounds simple, but it's hard actually, and then once you get that plan, once you've kind of stress tested it. So when you're building a portfolio, building a set of strategies, kind of look at it. Well, how did this go over the last 5 years? And get a sense of what those swings could be. Because there are, if you're investing for 20 years or 5 years, even, you could have a year like last year that was just challenging.
Yeah.
But if you've gone through and and looked at that and say, what, big down years happen, but they were in the assumption when we put this together, we assumed that we'd have a bad year, and we were still okay, because they happen. So it sounds kind of, maybe that's too simple an answer, but we really think that's a success. Okay, we planned for this to be able to go in. Yeah, last year was a challenging year for the market. We planned for this, and also, but the time horizons are important. One of the things we did in challenging markets is we kind of hoard long-term data. So we'll pull out like 100-year charts to see, is this, what's going on? And, right now, I think one of the challenges a lot of investors have is they haven't seen rising interest rates. Right. So but you and I know in theory, rates go up, bonds go down. It's one thing to say that, it's another thing to internalize it. Oh my gosh, my bond portfolio went down. Well, yes, it will, because rates went up, right?
Yeah.
So we try to model that, stress test things.
I love it. Yeah, Ray Dalio talks about that. Like, it's another one of these. You might not have experienced it, or I have not, but like the pandemic, people wearing masks, but it happened 100 years ago. So it's another one of those. If you're not
Right,
familiar
right,
with the whole, your
right.
point about history rhyming, I love it.
Yeah.
Anything, Stephen, that you'd like to share that I haven't asked before we wrap up?
No, I think we've covered a lot, but yeah, history repeats. That the pandemic was interesting. Yeah, Philadelphia had a big issue with that. So we pulled a lot of the articles like in the 19 for that, for the Spanish flu. And this is sort of an interesting story. I knew through an older family member that their house hadn't been touched much since 1990. She lived in the same place all her life. And they actually had beds they had sawed in half.
Wow.
In 1919.
Wow.
I remembered that. I was thinking, okay, this could get interesting. People
Wow.
were sawing their beds in half in 1919 because they just didn't know. The scope of reaction to things can be pretty interesting. So yeah. So if you get a period like that, try and what happened in similar times? But
I love it.
good
I love it.
guys.
Well, excellent. Stephen, thank you so much for coming on the phone. People can get a hold of you. LCLG is the ticker.
Right.
And what's the best way for people to get a hold of you?
Yeah, we're a website, logancapital.com. All our contact information's there. And yeah, so appreciate the opportunity.
Beautiful. Thank you so much, Stephen. We'll see you
Thank
again
you.
soon.